Hello, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is your Cracking the Code to Trading Options. This is going to be a guide. I'm going to help you guys through all of this. We're going to build from simple concepts to real-life examples in this video. And by the end of this, I think you guys will have a solid understanding of how options are working and those levers and pulleys that most people miss on any given day when they're trading options. I see it all the time, folks. People getting involved in options and not really knowing when the timing is that they should be buying and when the timing is when they should be selling. You folks, after watching this, I think you guys will have that understanding almost intuitively after we get through this, probably halfway through here. All right, so without further ado, we're going to be doing this on the long call diagonal. This is one of my favorite ones, especially right after earnings, because it kind of sets us up for the next earnings cycle, gets us involved on a longer term trade for a bullish move. Now, with that said, I'm not going to really talk about this strategy until the very end. We're going to walk through this video as if it was any given day, and we go through, look at an underlying that in this case would be bullish, long-term bullish, as a matter of fact, and that would then lead us to this type of strategy. So without further ado, we're going to be doing the long call strategy or long call diagonal, like I said, but put that on the shelf for just a moment because I want to talk about this for a second. This is helping us crack the code to trading options, believe it or not. And this is code that is sent over the internet at any given time. And it's the most streamlined way, the fastest way to transfer data. And it's using O's and ones in different orders. But the fact of the matter is if we were going to take this and freeze frame it, peel back the layers of this onion, we can easily see that it's just O's and ones. So it's not as intimidating as it originally looked when it's just streaming lines. And we still find that today when we're trading options, going over to that option montage page, the one with the calls and the puts and all of those numbers that are constantly fluctuating, it can be intimidating. It could be like you're looking at the inside of an airplane cockpit when you have no idea how to fly. And believe it or not, people do that every day, go into the options not knowing what those numbers mean and those metrics and still trade around it, not understanding fully that they could be directionally right when they put on this strategy and still lose money because they didn't understand how these options are working. So back it up just a little bit. Let's go to another simple concept. What is one of the best investments any person can make? And I'm not necessarily talking your opinion. Let's talk about this as if you were at any conversation in any given day. Most people, when you're talking about a great investment, they will say the best investment is to buy a house. Has anybody ever heard that? If you've heard that same thing, the best investment one can make is to buy a house. Throw a Y over there in the chat window for me. If you think you have another better one, throw an N over there. But this goes all the way back. Mark Twain talked about it. Rockefeller was the most famous one that I know of that spoke of this. And he said the best investment one could make was in dirt. And that's because he was talking about the fact that we live on this globe, this planet here, and there is only a finite amount of space for all of us, right? So if you could buy up a vast amount of space right away before everybody else, then you're the one that ends up selling that to them, and those prices are likely to go higher because this is as simple as supply and demand. Now, when you guys are watching these spotting the trade videos in the mornings that I do, you guys hear me talking about the levers and pulleys of the markets all the time and how there's supply, demand, fluctuations going on, especially with crude oil right now. It's a great example of limited supply and an increasing demand. We just recently saw the crude oil numbers drop like by 3 million barrels. So the fact of the matter is we're seeing crude oil prices rise because everybody knows there's a limited supply and increasing demand. And that's what Rockefeller was talking about in regards to land, is the fact that there's a limited supply on this globe of land. And if you got a hold of it early, then you are going to do very well. But that said, if anybody has watched housing prices in the past 20 years, we've seen them do all kinds of jukes and jives. Coming into the 2000s, from 1990 to 2000, we had a bit of a scare with computers crashing and everything else, and we had the dot-com crash, markets did pull back. And so did the housing markets. We saw housing prices actually drop during the 2000s there. So yeah, prices can go down. But again, most people will talk about the rebound that we saw heading into the financial crisis. But then in 2009, when everybody thought their houses were going to always go up, we got the financial crisis, and we probably saw housing prices drop back down to those 2000 levels. Since then, we've gotten a nice rally again. And then what happened during COVID, we did actually see, even before that, in basically COVID, when we saw the COVID crisis happen, we got another little bit of a dip there. I'm trying to think of it. The last dip we had was all right. So anyway, we got a little bit of a dip there and then almost parabolic. So while it does seem, at least at this point, housing prices, had you bought back in the day, they have done very well. But a lot of people bought right before the crash in 2009 and sold at those bottoms. So it's not always the best investment. And you can't always tell when people are telling you it's as simple as go out and buy low and sell high. It's not always that easy. It's about timing. Had you bought equities 3 months ago, finally decided to jump on board, well, you have seen those markets really come off. I think that we're going to see another market dip here because, again, levers and pulleys of the market, we have a teeter-totter, right? And what's happening right now is we have interest rates, right, and dollar price. So when I'm talking about dollar there, I mean price of the bonds. And what happens is as the Fed is pushing interest rates higher, right, what happens to the price of those bonds is they go down. They're inversely correlated. But on the other side of this, when we are talking about yours and my budgets, right, we have a finite amount of money to spend every month. We know what our income is. And most folks out there, now I'm not a financial advisor, I'm not a fiduciary, but talk to your financial advisor or a fiduciary. They say that generally speaking, you should not allocate any more than 25 to 30% of your monthly income to a mortgage or to rent. Okay. So with that said, we have a finite amount of money that we could spend on that. We know what our income is. If say, for instance, it's $5,000 a month, then, we could be allocating somewhere around $1,500 to a mortgage to fit that ratio there. All right. And that said, now we can spend $1,500 on a mortgage. So if I was going to spend $1,500 on a mortgage a couple of years ago, or even last year, that was all going to principal. So you were paying down that house almost immediately. And now with what's happening, interest rates rising, I can still only afford that $1,500 towards a mortgage. And now before I might have had, let's say $100 was to the interest and basically $1,400 was going to the principal, right? All right. Now what we're seeing is maybe $350 is going to the interest rate. And now we're only getting basically $1,150 towards principal. So if we only get that much towards principal, it means that we can only afford a smaller house, okay? Because the interest doesn't count for that house. We still can only afford $1,500. Now the interest rates rise. More of our money monthly is going to pay off that interest rate, less to pay off a house. That means the house that we can afford is smaller. That said, what happens when multiple people, everybody starts doing that? And now that house I was looking at, interest rates just increased again, right? We just saw the FOMC. Well, that means today I can afford less of a house. So I'm not looking at that house anymore. I'm looking at this house. And what happens now that I'm not looking at that house, it will likely see the price drop because it sees that it is overpriced now. So we definitely should see housing prices dip a little bit. I don't think it's going to be massive because I believe the economy right now is doing very well, or not very well. I shouldn't say that. We did get 2 quarters of negative growth, right? But all in all, everything outside of that seems strong. We've seen inventories, manufacturing numbers pretty decent compared to what we're seeing in these GDP numbers. And a lot of that is due to the inflation that we're seeing from some of these other products. So while it is a novel idea, folks, like I said, to buy low and sell high, it is not always that easy. But options could give us a little bit of a clue here. So with that said, let's talk about markets and how we try to capture or determine what value is, right? When we're talking about a stock, we've seen stock prices pull back recently, and that is due to the fact that they are given a multiple. So when they have their earnings, they have earnings per share. What the economists, or not the economists, the analysts do is look at that underlying, say, okay, that's what they did this year. They're on this trajectory, doing better every year, maybe increasing 10% every year. And for the next 10, 15 years, I'm putting a multiple on what that price is today. So when I say it's a 20 multiple, now that increases the price or the value, the expected value of that stock. And then when the economy starts doing bad, the analysts come out and say, you know what, it's not looking like they're going to have that growth trajectory that we talked about. It looks like it's maybe a little bit more flatlined. I'm pulling back my original call of a 20 multiple and saying it's about a 10 multiple. Now that price almost cuts in half, right? We saw just recently with Walmart saying that their EPS year over year was going to drop by 10%. What happened to their stock? It dropped by 10% that day. So we see that happening quite a bit. And that is due to the fact that when we're trading stocks, there is a multiple on those. It's not today's value. It's the future expectations of value. All right. If that makes sense to you guys, please throw a Y in there. I'll move on. Otherwise, I will touch on that a little bit more if you are still a little bit confused there. So when we're looking at this, trying to buy lows, you know, novel idea, right? Buy at the very low. It's so easy, and then sell when it gets up to the top. But the problem is we don't know what's going on from here out, really. It could continue to go higher, right? That's the conundrum we constantly are in, because we don't know what's going to happen going forward. But with sideways markets, they are a little bit easier, folks, to find support and resistances. And if you chart, or you like to look at charts, these support and resistances are key to finding levels where there is value. All right. And some of the easiest for newer traders to trade are the sideways trending markets. Capture them on the support, get out of them on the resistance, even get short on those resistances. IBM, Kroger, I think Kellogg is another good one, but IBM and Kroger definitely top of mind right now on always trending sideways. IBM's been basically trading in the just above 100 for the last 10, 15 years. So it really hasn't gone anywhere. So that's a great one to trade. Check out those support and resistances and get your feet wet trading around something like that, where you don't have that massive upside risk or massive downside risk. Okay. So our eye lines up better with sideways or horizontal trading markets, believe it or not. Vertical ones are a little bit more for the trained eye, because the markets can do all kinds of back and forths, right? And you're going to try and draw in your support and resistances there. Bearish markets are the same, but because you get lower lows and lower highs all the time, it's kind of hard to figure out where that future lower low is going to be. So bullish and bearish markets, a little bit more of a trained eye to catch those trend channels. Whereas a sideways market, it's pretty easy. You can even just go to Fibonacci or something like that, and it lines up pretty nicely with sideways trending markets there. And what usually will happen, though, is the market will take off, do a little blip down. That's where we look to buy, right? And probably don't sell here. Why? Because our future expectation is it's going to rally harder. Well, it pulls back to where we are, where we're starting to bite our teeth, right? And get a little reprieve. Okay, I was smart after all. I did buy on that dip. That was a good dip. You know, could have bought there again. But what happened? Boom, drops out of bed right to that original area where we wanted to buy but didn't buy. And that's usually where we end up selling and puking out of this trade. because again, we don't know what's going forward. We're worried about further downside in this underlying, but it's not as easy to just say, just go out there and buy low and sell high. It often feels like you're buying high to sell higher, which is probably a better analogy there. But here on sideways trendings, pretty easy. We can line it up with our eyes pretty good. We know we would want to be not selling down here when it retraces. We want to be buying down here. Sorry, I've got dogs breaking into the house. There we go. All right. So sideways trending markets usually are the ones that are going to do better for the newer trader. And options, they give us a tell when they're cheap. Because when we think about this, if volatility is a gauge of the premium, or a gauge of how far this underlying is going to move. And usually when volatility is climbing, it's expecting a bigger move in either direction, okay? But the key here is with options, especially volatility, we have volatility that looks like this because every individual underlying, and I'm going to say this is implied volatility more specifically. I don't want you to be thinking of the VIX when I'm talking about this. We're talking about specifically implied volatility for a specific underlying. So the VIX, while it gives us a broader gauge of volatility in the markets, because it's kind of gauging off of buys and sells of options, implied volatility is for that specific underlying. And what happens is with implied volatility, it has a tendency to have a nice tight or pretty good tight range for that underlying. Now, we don't want to get in the habit of contagion where we're looking at Tesla and we're looking at Kroger and saying, well, wow, Kroger doesn't have any volatility at all. Kroger's kind of weak on volatility because if I look over here at Tesla, Tesla's up in the 90s and Kroger's down there in the 20s. Well, that's not what we need to do. We need to compare apples to apples. I need to know where Kroger's 20 is in relation to Kroger's range, because an underlying, like I said, will carry its range pretty tightly over the course of several years. Now, a lot of times, especially recently, I only go back 6 months to kind of get my gauge because of the volatility the markets has been seeing. But I will show you in several examples today where you can go back in time and look to see if that range is still intact. And most of the time, it is right in line with pre-pandemic. Now, the pandemic spike did break out, kind of like what we're seeing with this market with a breakout there. And that will happen on occasion. But the pandemic spike, we aren't going to probably see one of those for another 10 years. Last time we saw a spike like that was basically during the financial crisis. And I don't even think the financial crisis had that big of a spike that we saw during COVID. So with that said, I'm not going to take that data point out of the picture. I'm going to keep that, in my back pocket or in the back of my head so that the next black swan event, I have at least a level where I know that this market will likely go to. But when we're talking about implied volatility, it has a rule, and it's based on percentage point, right? And it's a 1 percentage point increase. And if you've ever traded options, all of those options are changing in price due to the Greeks. And I'm going to explain those here in a minute and make it really easy. I got some hacks for you guys to help you remember these and what they do and really what you should be concentrating on. But volatility, all the options tell us that there's one rule basically, and it's based on an advancement, meaning if the underlying moves higher by $1, if 1 day goes by, if volatility or implied volatility, Vega, increases by 1%. So yes, Vega is just implied volatility with a fancy name. Okay. So if you see implied volatility or Vega, those are synonymous. All right. And it's based on a 1 percentage point increase. So when price our volatility is at these low levels for this underlying, what does that tell us? If we know that when we have an increase of 1%, all of the options pricing increases by the corresponding Vega coefficient. All right. So if I'm looking at 100 strike and the Vega for that is, say, 23 cents, well, if the implied volatility or Vega increases by 1 percentage point, I know that those options premiums are going to go up by that amount. All right, just on the 1 percentage point move. That doesn't mean that the underlying's changed price at all. I'm discounting that. The underlying hasn't changed. If just the implied volatility upticks by 1 percentage point, all those premiums go up. Vice versa, if it goes down by 1 percentage point, folks, the prices are all going to drop by that amount, even if the underlying doesn't move anywhere. So what we can say is then when options or the underlying ABC, XYZ, PDQ, IBM, Tesla, whatever, when we see their volatility down near this low level, that is telling us the options are super cheap, okay? And if they are trading up around this upper band, then that's telling us that options are super expensive. Well, actually, this is super expensive, but we know they're getting expensive when it starts coming up and testing that resistance area. That's where we would want to start getting involved in strategies where we collect the credit, except for in the butterfly, right? We've talked about that one. That's one of the outliers, and we talk about why in that video. We don't have to worry about that in this video. But with that said, if volatility is down here, we know it is cheap, right? And if we know it comes up here, it is kind of expensive. So we want to be buying options when the volatility is at these low levels and selling them at these upper levels, all right? Because we want to sell high, collect a nice fat premium, and buy cheap and get that skinny premium, right? So we need to be good stewards of our capital when we're trading options. And the only way to do that is to know when you should be buying or selling options. I can't tell you how many times I see, like on Twitter, even on national TV business news, folks talking about buying options in the expiration month that only has like 25 days left. Like that is literally the worst place to be buying and the wrong time, because those volatility coefficients are extremely high a lot of times and they're still buying. They have to make that outpaced move in order to be profitable. If volatility just started cratering, if volatility started doing this while we were seeing the underlying move higher, like say XYZ is, trending higher in price. Well, if we bought calls and we saw this happen to volatility, we actually could in fact have lost money on a trade where we nailed the directionality. All right. So don't get caught in that. If you get involved in an underlying with high volatility, you do not want to be buying at that point in time. All right, so let's get on with some real life examples. These are real life examples, but folks, I'm not even caring what the underlying is because I just want to talk about what this is doing with price. And when you're looking at these charts, try and draw yourself in some lines. Now, you could be really aggressive and come, right in line with something like this. Oh, I did it a little early. I threw the lines in there for you. But anyway, you can come in here and draw in some lines. Now, I would probably be a little bit more aggressive and come in probably right along this line, kind of clip a couple of those and then draw it along the bottom there. I don't care if you try and hit all the tops, just know you're going to have less opportunities because you want it to kind of get as close to that line as you can before you start selling those options. And then you get these markets. You can see when it gets up to those levels, we start seeing some volatility coming out. And when it gets down at these levels, that's when you want to be buying options, because this volatility increasing is actually helping you out, because as that volatility goes higher, your premiums are increasing. So we want to make sure when we're trading options that we know what our headwinds are and what our tailwinds are. And volatility is the key to that as far as I'm concerned, because at any given time, price could increase or decrease based on this. Now, yes, there's a couple other option Greeks that will cause the price to increase and decrease at any given time. And we'll talk about that here in a moment. But with this, we want to try and capture it when we are buying cheap and selling high. And you can do that on just about any of these markets. You draw those lines in there. I like I said, like it to pierce through. I don't mind that if it goes through for a couple of percentage points. I want to try and capture it when it's at that relatively high level, because it will give me more opportunities or give me the signal that the opportunity is there, if you will, because I can see that when it breaks through, it doesn't last very long. It usually reverts back to the mean rather quickly. So we want to take advantage of those types of levers and pulleys so that we can actually make money despite the fact that we totally cratered the directionality. And here's that last chart. I just drew it out, sent the lines out to the left, and you can see, lo and behold, pre-pandemic, pretty much in line with where we are today, or the last couple of years post-pandemic. All right. Now, there are some that have created a new paradigm. Sometimes they have increased. Those are few and far between. NVIDIA is a perfect example of that. We'll get that here in a moment, but we can see volatility near its high. Try and draw in these lows here, off those lows. Send those lines out to the left, and we can see that again, pre-pandemic, we were pretty much in line with where we drew these and sent them out to the left. All right. So you can see that when we are looking at this underlying, like I said, it doesn't matter what it is, we can see where that range is. And again, if we go through this, 45 being high for this underlying, you can see that 45 probably would not have been even that very high for this underlying. 60 would be considered relatively high for this underlying. So we don't want to compare different underlyings. And here you can see that this one rarely gets above 45. And so we want to make sure we're comparing apples to apples. We want to look at this particular underlying's implied volatility, this number here, in relation to where it's been in the past. And then basically, folks, what I do is just draw a line right down the middle and try and get it as close to the middle as I can and say, you know what? Here we go. This is your sell zone on options premium, and this is your buy zone. All right. Now, I don't care, like, especially if you're a newer trader, you could even do a couple of more lines in there and maybe break it into quarters. And now this is your sell zone. You're going to wait for the best probability. And this is your buy zone. All right. Down there, you're waiting for those extremes. All right. And I have no problem with that. We actually have option strategies that we can put on. As a matter of fact, we talked about the butterfly last week that we could put on when that volatility is right in the middle. We can isolate it a little bit. All right. Everybody with me so far? Throw a Y over there if you're still with me. This is one of those where I talked about the paradigm has shifted. It's gotten a little bit higher post-pandemic here. And this is NVIDIA. And we can see that when we send that out pre-pandemic, NVIDIA had a much lower coefficient. Now the paradigm has shifted almost an increment higher there, right? That is mostly due to Bitcoin. It's really correlated to Bitcoin right now. But again, we would not want to be comparing NVIDIA right now to some of those other underlyings we were looking at. Some of those other ones didn't even get as high as 55, right? We're kind of looking at 55 right there. So 55 to basically 90 is this underlying's range, which is NVIDIA, like we talked about. So we couldn't compare Kroger to NVIDIA. We want to compare NVIDIA's to NVIDIA. Does that make sense for you guys? All right. All right. Now the dogs went out. All right. So volatility drives pricing. If you haven't learned anything else so far, volatility is the driver, the main driver of price. Okay. Now we can split hairs here, folks, and talk about theta. As a matter of fact, let's just do that. Let's just split hairs and talk about theta and all of these. Because yes, the underlyings can increase and decrease at any given time because of any of the Greeks. And the first one that most people will talk about is delta. All right. So we have delta. Everybody has a pretty solid understanding what delta does. And it's usually wrapped around XYZ. Okay. And we could say that if XYZ was trading $200, okay, and we go over here to the delta or whatever, the calls and puts. Let's just say we've got some calls and puts. I'm going to go a little bit lower, try and draw this in a little bit better. So we've got calls and we've got some puts here. All right. So when you're looking in those options, you're going to see stuff that kind of looks like a 90. They're going to go 90, 95, 100, 105, 110, right? And then these, oh, sorry, actually, so let's just do this. One, we'll make it a 200 lot. $200 stock. All right. So these at the monies are basically a 50-50 delta is what we usually see. So if we got the delta over here on the calls, I'm going to say it's a 50 for these 200 puts or 200 calls. The puts are a negative 0.50 delta. All right. Because it's based on the assumption we're going to increase, right? So if we're always increasing and puts give you the right to sell the underlying, well, as the underlying is going higher, nobody wants to sell the underlying below the market. So we could say that those are 50-50. That's because the theory is that on any given day when you go out and buy a stock, you have a 50-50 probability that the underlying is going to either increase or decrease right after you bought it. Okay. So it's a 50-50 bet. In the money for the calls, that number gets a little bit bigger. So we could see this number kind of go to a 55, let's say, as it goes deeper in the money. The ones that are going out of the money are going to go a little bit lower. So we could see those go to 45, right? Because it goes back to options give you the right, but not the or calls give you the right, but not the obligation to buy the underlying. So nobody wants to buy it above where it's trading right now, and take possession. You might buy some calls and stuff like that, but at the end of the day, nobody really wants to take that. And then as it goes down, we could see a negative 45 here. And as the puts go in the money, you're going to see that delta increase, right? And then the at the monies, we could see something like these are going to be $2.50. Let's just make it easy for me, end of the day math. $2.50 at $3, and we'll say the at the monies are the same price on both sides, $2.50 at $3. Okay. All right. So we talked about this a little bit. Delta tells us that if the underlying increases by $1, our premiums will increase by the corresponding delta. So if we went from 200 to 201, now we would see these increase by 50 cents, right? We would see the calls increase by 50 cents. They would go to basically $3 and $3.50. The puts, on the other hand, are negative. So those are going to go down and they're going to go to $2 and $2.50, just based on the underlying moving higher by $1. We have on the floor a lot of different things that we use delta for, and almost rarely do we care about how much delta is going to affect my premium based on a dollar move. All right. That was the last thing on my mind. I was more concerned about the probabilities delta was telling us. Probabilities of my call finishing in the money is correlated to the delta. So if we're talking about my 200 calls, I've got a 50% probability of finishing 1 penny in the money at expiration. Okay. I hear this talked about a lot wrong on the web. And a lot of people say it's the probability of the underlying going up there and touching you. No, it's the probability of finishing 1 penny in the money. The probability of the underlying going up and trading to, let's say, 225. Sorry, I went a little bit too low there. Well, let's just say it's 210s. So the 210s there are say a 40 delta. I can't get my pen to want to work on there because going a little too low, I think, because there's little thing down there. So let's just say that the 45 delta. So two times delta equals the probability of touch during the life of the probability of touch. All right. Of touch. I guess I got to write it all in there. Touch. So it tells us 2 times the delta is the probability of touch. That means during the life of this option strategy, a 50 delta means it's got 100% probability of the underlying trading that price. Well, we already know that's true because it's the at the monies. But then these 2 10 calls that we're looking at, they have a 40 delta. So 2 times the 40 delta is 80. So during the life of this option, the XYZ, while it's trading at 200, has about an 80% probability of trading 210 during the life of this option. That's what delta is telling us, the probabilities. That's what I would rather know more than how it's affecting my underlying going up and down. All right. Then we talk about the next one is gamma. And the easiest thing to think about this is gamma just goes with delta. Gamma goes with delta on dollar number 2. All right. So that was dollar number 1. We are on dollar number 2 now for gamma. And gamma is usually a pretty small number. Let's say the at the monies are going to be somewhere around 5 cents or something. Okay. It's usually a couple pennies to 5 cents. Closer and closer you get to expiration, that number really rallies up. So on the second dollar move, gamma goes with delta, right? So we would then on the second dollar move see these prices move to $3.55, right? Because it went 50 plus the 5 with the delta. So 55 at 405. Okay, so we would see on that second dollar move that those prices moved in conjunction. Now gamma goes with delta on the put side too, right? Gamma goes with delta there, but note that gamma is positive and those puts are negative. So on that second dollar move, a positive plus a negative makes it negative, but a little less negative, right? So if we had 55 cents here, that second dollar move, 5 cents plus negative 50 cents makes it negative 45 cents. Does that make sense, folks? Please throw a Y over there in this chat window so I know you guys are still with me. Gamma goes with delta. So now we would see our prices decreased by 45 cents. So they would be at $1.55 and 205, right? Because they only dropped by 45 cents. 50 plus the 0.5 or 0.05 gives us 45 there, right? So gamma goes with delta. And then we have the thief in the night that comes and steals your premiums, right? And that is just theta. Theta is the thief in the night that comes and steals your premiums. So the easiest way to remember him, he's the thief. He's always negative, okay? Every single day, that guy is trying to take money out of your pocket. Further out in time, yeah, he doesn't really know you're alive, to be honest. Actually, he does know you're alive. He's taking a couple of pennies here and there. He never stops. So as soon as you get involved, you're on his radar. But the folks he's really concerned about are the ones that are getting ready to expire, and that's where he's grabbing fistfuls. So what we see happen with theta is out in time, it's a little less drastic. It does always decay, but then it starts picking up and then really starts dropping off. So the drop off happens at about 7 days to expiration. And I don't really do a lot of trading inside that 7 days. I like to get out further in time, get a little bit more premium, wait for my move to happen. Inside of 7 days to expiration, you're really gamma trading because that gamma gets really jacked up. And as it's moving back and forth, that gamma really helps you out. Theta will really, as well as that, it's going to go crazy. Now, here's where I think the sweet spot is. It's 35 days to expiration, and we can show charts all day long about it. I will also go out to around 45 days to expiration to enter because I want to get involved right before this underlying really starts falling off. And this going that way is your sell zone, right? Because theta is really getting aggressive. So think about it as if you had price here as well. We see basically a 50% drop during this 35 days to 7 days. It's basically a 50% drop in premiums due to theta. Okay. So we want that. We want to take advantage of selling heading into that massive downward trajectory. We don't want to be rolling a ball up this hill that way. It's a Sisyphean effort. But you get out here, we're talking like 70 days to expiration. You can see that it's relatively flat. It doesn't really even increase. You could go out to like 180 days and you're still not going to see a massive increase in theta decay or time decay during that time. So I like to get in right around that 70 days to expiration, usually when I am looking to buy and be a good steward of my capital, right? And then finally, what we look at is, I'm going to have to erase some things here, it looks like. I'm just going to erase everything. Does that make, before I erase all this, everybody clear a concept here so far? Sell zone, buy zone. Because I'm going to erase it here. So throw a Y over there if you guys are all good. If not, I'll go over it again. All right, good. All right, the last one is obviously our Vega. Maybe not. Vega. Vega, which we talked about, is just implied volatility. All right, implied volatility is, all right, Vega is just a super fancy name for it, part of the Greeks. Now, Vega is always positive. All right. So it's based on an increase of 1 percentage point, like we talked about. It is going to affect the further duration options more so than the near duration options. Does anybody know why? You can throw it over there in the chat window. I'm keeping my eye out there for anybody that has any questions throughout this video. If you have a question, you want me to slow down, please throw it over there. We're on YouTube and Facebook. I know for some reason, sometimes it's a little bit more difficult to get to comment on one of those. Some folks have said. So for a clearer concept, we'll get moving along here. So why does volatility affect those further duration options more? Because it's more unknown. We know what's going to happen like the next couple of days, next week or so. At least we feel like we've got a pretty good handle on that. But way out 70, 80, 3 months from now, we really don't know what's going to happen. I mean, we can all say, hey, we're going to be in a recession or we're going to, be going gangbusters, but nobody really knows. We're just talking our opinion. So Vega, while delta, gamma, and theta all affect the premiums and in different ways. Remember, delta is based on a move higher or lower. Gamma goes with delta. Theta is that thief. The thief is always negative because we can't go back in time. We can only move forward in time, right? Theta is more aggressive, closer to expiration, because it's got to take all of the premium it can before that option expires. And then Vega is the one that I want you guys to really key on, because Vega, if it increases, the premiums increase, despite the fact that the underlying could be going down. We could see them offset each other, right? We could see Vega start to go down. The underlying goes down. The puts go sideways, right? Market goes down. Those puts should be increasing, but we got volatility going down. So those puts are being counteracted by the different coefficients, all right? So again, imperative that you know when you should be buying options and selling options, because your success rate really is going to be when volatility is moving. Yeah, you could say theta is more expensive way out in time. Those options are a lot more expensive, blah, blah, blah. But what I'm talking about, if we, again, freeze frame, peel back the onion. If we looked at, I don't know how many days the expiration are right now, but if we looked at XYZ, all right, today, let's just use IBM because IBM is probably a perfect example. Oops, IBM, dyslexia. IBM. So right now, I think it's trading right around 120, right? And volatility is within its range. So what I'm saying here is, if I were just buying calls based on a bullish move, I wanted to buy calls and volatility started trickling down, well, those premiums are going to start going down or counteracting the positive move that Delta has, all right? Especially if you are buying calls further out in time, right? Because that Vega is more, and you bought the Vega when it was really high, volatility started coming down. Well, guess what? Yeah, Theta's not hurting you, but that Vega is really crushing you. And I've seen, as a matter of fact, there's a couple of times in history that we have seen this whole dynamic happen. During the dot-com crash, I knew a guy that had calls on, was long calls going into the dot-com crash, and was able to cover them for a scratch during that blitz to the downside because volatility exploded. People were buying options without regard to price. They didn't care. They were just panicking and going out there trying to buy some protection, not knowing how much they were paying for it or caring. They just wanted that protection. And what they're doing is exacerbating the problem. They're really not really limiting their risk at that point. They're increasing their risk, because if the underlying reverted, they would start to make money there, but those puts would crater in price due to volatility and the reversal of the action in the markets. So we don't want to get involved in that. If we have a bullish assumption, the first thing we need to do is understand where Vega is, because the Vega is going to tell me if the prices are cheap or expensive. I'm not talking about the further duration options. Yes, they're more expensive. Why? Because you got to pay for time to be right. The near duration options, or the ones that are getting ready to expire, are a little bit cheaper because you don't have time, right? You have to pay for added time, which is why those are more expensive. But if we looked at XYZ or IBM at 120 today, trading at 120 even, let's say, and the volatility, let's skip volatility, and it's basically 70 days to expiration, all right? And we're looking this year, 70 days to expiration for this option, all right? And then I move forward 6 months, and the price is still trading at 120. Vega is still, let's just say Vega is still 50%, okay, or 0.50, whatever you want to, however you want to say it. The price of all of those options in the 70 days to expiration, if we still had the same volatility and still had the same strike price and still, or same price of the stock, same days to expiration, all of those, the price should be the same, okay? But if this Vega is higher or lower from there, our price is going to be different based on that Vega, okay? So 70 days to expiration, those prices should be all the same if all else is equal, besides volatility moving higher or lower, all right? If that makes sense. All right, so here is a real life example when we were looking at for an underlying FedEx. Looks like volatility is relatively in the middle there. I think I missed out on what I wanted to do, but let's simplify those options. I got a little ahead of myself. You don't have to worry about the Greeks. That's where I started talking about those. I can't remember what I wanted to do in that other, put that blank one up there to do some writing on that. Because I was thinking about something I wanted to add to this video. Maybe I'll think about it in a second. All right, so let's get into the option montage here and break this down. It's already not as intimidating, right? Am I right? You guys can look at this and actually understand what's happening here. So what we've got going on here is the calls are on this side. There's the calls. We've got the puts, right? We've got our delta, we've got our gamma, we've got our theta, we've got our Vega on both sides. Whoops, bid-ask, right? All of those still there. Delta, positive for the calls, negative for the puts, right? Gamma, we know gamma goes with delta. Theta is the thief. Look how aggressive theta is. We go out here close to that 70 days, outside that 70 days to expiration that we were talking about for buying. Well, look at what the theta is, 9 cents. We move in 30 days. How much does it increase? 2 cents. It goes from 9 cents to basically 10 or 11 cents, 1 to 2 pennies. But what happens inside that 45 days or 35 days? You go another 30 days coming in. Look how much the theta has increased. All right, by almost what is that? 70% increase. Whereas back here it was basically a 1 or a 2% increase. Now we got about a 70% increase. Or actually, it was about a 10% increase. Now we got about a 70% increase. Then you move in the next only 20 days and look at that. It's basically looking at 5 times increase, maybe 4 times increase, right? 4 times increase there. So quadrupled its take. Now we can see that still happen over here. Theta is still negative on the put side as well. All right. Now we look at Vega. It's always positive, calls and puts, but look how much more aggressive it is out here in time for that volatility coefficient. So again, that's why we want to get involved, buying further duration, limit theta decay, take advantage of volatility increasing if that happens, and buy it when it's pretty cheap so we know that it's got some support there, and then ride that out. If we were going to take advantage of selling, we want to get in here and then see this happen to our premium over the next 20 days. So that's why we want to be selling in a situation like that, because we sell high. Theta helps erode those premiums. They go down. We want to sell high, buy low. And that's exactly how we do it. Inside of 45 days to expiration, taking advantage of that type of volatility and theta. All right. So here's our example that I was going to be using today for the long call diagonal. Coming in or out of earnings is a good time to put this on. All right. A couple months before earnings, I would say. Right after is great because we get the volatility to come out, right? Diagonal, I'm buying the long term. Now, I didn't go way out here to the 87s on this particular example, because one of the things you'll notice with this trade is that I am going to be offsetting a lot of the theta decay. If I'm taking advantage of the theta decay in this situation, I should say. So I want to be buying an option further out in time. What I want to do here, as a matter of fact, I'm going to pull up my platform. Oh, it sounds like we have girls home and they are chatting in the other room. Should I knock on the door or knock on the wall? All right. So here we have this underlying. Let's go to FedEx. And let's walk through this like any given day. I'm looking at this underlying. I'm thinking I am long-term bullish, that does have that earning right in there. All right. That's one reason why I opted to move just slightly in on the first example we were giving here. But I am bullish on it long-term. I think it's already had its correction. Volatility looks like it's continuing to come out a little bit. How can I take advantage of that? By selling in that front month. All right. So if I go over to the options page, all right, and we're going to be looking at this page here. You can tell I took that screenshot a couple of days ago because I wanted to get ahead of this. And I don't remember what strikes I was using. A 200, 235. Just so I can stay consistent here. All right. So 200s. In the monies. Now, what I usually do is I'm going to be looking for around the 70-ish delta. You can see in this one, when I was doing it 70-ish to 80s, all right? Remember some of those other ones, we were going all the way to the 90s. I like to come in a little bit further here. If we look across the one that we're going to buy, I like to go around that 80 to 84 delta. Come across here. If you're selling the 80 to 84 delta, you're going to be selling somewhere around the 28 to 34-ish delta. If you go deeper in the money, you're doing the 90, you're going to doing it closer to the 90 delta, say like an 86 to a 90 delta. Then you can start looking at the 16 delta calls usually to cover. But one of the easiest ways to do it is kind of pick your levels. I'm looking at the 200. I know there's probably going to be support there, so I want to buy that number there. And then just look straight across over here. The puts give you a little signal. The in-the-money calls have something that's called intrinsic value and extrinsic value. The intrinsic value is what this strike is actually worth. And in this case, we can look at the 200 calls and do the math really easy. The 200 calls coming across here, I guess it doesn't want to write a straight line for sure. 200 calls, right? 200 calls have to have the benefit of owning them. Meaning, if I own a call that is below the market, it has to at least be worth from the call strike to where the underlying is trading. All right, that is a rule. So what I can tell with this underlying trading, let's say it's trading around 225 because I'm looking at this number there. I know that this has to be worth $25 at least. It cannot go below that. But we see that there's a couple extra dollars there over that $25. The intrinsic value is the $25. That's what makes it equal to where the underlying is trading. That's the intrinsic value. That's the benefit of owning an option. It has to at least be worth that. In the money options have to at least be worth the strike to where the underlying is. All right. Everything else is theta or time decay and a little volatility to boot. So we can do a little floor trader hack rather than having to do the math. Just look at the corresponding out of the money puts. That tells you how much extrinsic value or theta there is. All right. So we know there's about $3.40. All right. I bought an option further out in time. I'm going to be doing a diagonal. I want to sell an out of the money different strike. Okay. The difference between a diagonal and a calendar is the calendar has the same strikes. The diagonal has a little bit more wiggle room for you. All right. So we would want to look at the corresponding puts, try and sell the nearer duration options that have the massive theta decay or the ramping up of the theta decay going in. And look at that. We've got our short option that has the better theta decay. And we have bought this option for what it's worth, $25. As a matter of fact, you can see when I did this strategy, I sold it and the debit is $24.85. All right. $24.85 means that I'm buying it below where the underlying is trading. Anybody see that? If you see that, throw a Y in there. If you don't understand what I'm saying, throw an N over there in the chat window. So with that said, I'll just do a little review. $200 strike needs to have the benefit of owning that, which means it's got to be at least worth the strike plus where the underlying is trading. That's $25, right? Now, these premiums are over that $25, but rather than having to go through the math, especially on like a 95, you know, the 160 and stuff like that, the math can start getting a little bit long in the tooth, especially at the end of the day. So here's your floor trader hack. Look at the corresponding puts, and that is very close for government work. I mean, it doesn't get it down to the gnat's ass, folks, but it is very close. But we look at the corresponding ones. Look here, that's what we want to sell. And a lot of times we can buy this underlying, get synthetically long, if you will, at a lower price than where the underlying is trading. So there's another benefit to that. Like I said, though, if we wanted to go deeper in the money or further out in time, one of the things is, oh, that's what I wanted to talk about in that one blank page. This is the key. I'm going to have to do that from, I have to do it because my marker's not working. Let's go back to this page real quick. As a matter of fact, let's go back one more. I'll erase all the ink there. We'll start on this one, that example. Okay. Now, we've talked about this a little bit already. We're buying one further duration option, right? And we're selling the nearer duration option. One thing we want to make sure of, being good stewards of our capital, volatility. We said if volatility is high, you don't want to buy, right? Well, with this strategy, we need to be particularly concerned about our Vega or our implied volatility. All right. Now we said implied volatility usually increases going out the curve, right? Further duration options should have that volatility affecting them more. And it does. We can see that show up here. But it also has a tendency to have an upward trajectory. Now this one is a little bit of a outlier being 44, but usually what we see is these increase. And in this case, we do not want our volatility to increase. We want it to increase less than 2 to 3%. All right. Over the 2 months. You can see here, it's actually gone down. That's a good thing because that means I'm selling higher volatility here. This is the calls I'm selling, and I'm buying calls out here with lower volatility. So I'm buying lower volatility and selling higher volatility in the nearer duration. So this is the perfect scenario, really. Now, you can see, though, had I picked the other month, I've gone from 36 up to 38 or 39. That's basically a 3 to 4%, almost a 3% increase there in that implied volatility. So that gets to be a little bit more expensive buying those versus trying to sell these nearer duration options. So I would like to see that volatility go down. I know I'm buying cheap, selling expensive. Does that make sense? If it does, folks, please throw a Y over there. I want to make sure everybody's clear concept here. And if you got a light bulb moment, don't be afraid to smash that like button there. You know, all those little things helps those folks out there that don't know about us, right? So 2 to 3% increase, less than 2 to 3%. Let's just say less than a 3% increase should be what we're looking at. That would fit that rule though, right? But again, this is a great example of we would rather have that downturn for our volatility where we're buying cheap volatility and selling the more expensive volatility. I'm glad I remember what that page was all about. All right. And we'll go through an example here of doing that further duration one as well. So again, I'm going to first kind of be looking at these 80s to about an 86. You can see here that if I was going to buy this 86, it's deeper in the money. If I buy that one, I could look across here, see it's $3. Then I need to come in here and sell something for right around that $3. So I can, while I'm going deeper in the money here, it's allowing me to get further out of the money here. Now, my rule for this one, it's not like a risk one to make one. It's really just to make sure that when you do this as a strategy, you are buying this underlying below where we're trading. This is getting pretty close there, right? I might have wanted to go down a little bit tighter on that call. What usually happens though, if you go too far out in time, especially like 90, 100 days, your idea here is then to sell the nearer duration because you still want to sell these nearer duration options because they've got the theta decay. I don't want to necessarily go out here to this one. I would rather come in here and maybe try and get out of half of the premium. So let's go back down to this one again, the $3, $4, and get out of half of that premium. This time, yes, I'm not getting it below where the underlying is trading, but the idea here is when this front call expires, right, I get to collect all that premium, and then I can roll it out to these and collect another credit, continue to lower overall cost basis. All right, so you can see here in the meantime, during the life of that other strategy, we've had the volatility continue to come out of this strategy, which is kind of what I was looking for, is the market to continue to see that volatility come out. So let's just take a look at what this strategy would look like today if I was to do it. Remember what was doing the 200s in the money and selling the 35s, was it? I think 35s there. So you could see that going back, I think I bought this for $25, right? $24.85, because remember I bought it just below where the underlying was trading. We've gotten a positive move to the upside. That volatility has gone down. You can see it's almost gone down equally. So they pretty much offset each other. But in that time, I've just since how many days? 2 days ago, I've seen this strategy increased by basically, whoops, I don't remember what my price was right now. So basically 24.85 to 27.85, $3 increase, 10%. That's a pretty good day, right? I mean, got the move, volatility coming out, it's helping me. Remember, theta is helping me here. Volatility isn't killing me on these in the monies because look, when you go deeper in the money, the volatility isn't affecting me as much. So that volatility going down is affecting these nearer duration out of the money options a little bit more yet. So that's why this strategy is working out so nicely and so quickly. Just to give you guys the heads up on what this looks like, on the Analyze tab, you can see that it's kind of a swooping move. It's basically because of the volatility. You have two different expiration cycles. Those volatilities and thetas are going to affect the strategy differently. And then you get up to this area. That's where the short call comes in. Now, remember, you can continue to see this profitability go higher. If we came up here, the covered calls you took off the covered calls, right? This market would continue to gain, or this strategy would continue to gain in price. I would hope that you would go in there and sell some calls somewhere around, let's say the 265s or something like that, roll those calls out and up if we had that opportunity. And then you've increased that spread width and increased your profitability while lowering your risk. Remember, when you're selling a call against something you own, you're lowering your risk. The reason why you're lowering your risk is because you're lowering what you paid for it, okay? And that's what I try to teach throughout all of these. Stay mechanical with this stuff. It's not always going to go higher. As a matter of fact, I have a great webinar, or back during right after the dot-com crash, I traded PIN stock from basically $4, let's call it, all the way up to $140. And I did covered calls on it the entire way, lowered cost basis to where I was negative cost basis on a trade. So I owned it for free and then some. They were paying me to own that. And it was going parabolic, folks. Like, you look at the stock of PIN during that time, I probably have a chart of it somewhere, and it went parabolic, basically. Right after the pandemic, Portnoy opening up a bunch of presents, he sent this market to the moon. So let's just do 3-year. I'll do it on the week chart. As a matter of fact, you can see I even had the charting on here. I bought it on this day that it made that low. I did not buy the low, but it was very close to it. And started doing covered calls against this trade in that parabolic market the entire time, lowering my overall cost basis. Not every one of them worked out. I had to cover some of them early because I was worried about the move. But again, was able to cover or lower overall cost basis to negative on that trade during that rally. So yes, it can be done. Covered calls aren't always going to get your stock called away. All right. Now, would I leg out of this? Absolutely, I would. I would leg out of the short calls, especially if we started getting the move higher, cover those, or if my opinion changed and thought, hey, you know what? They are going to go parabolic because of some news, UPS, I don't know, whatever, some kind of battle there. Well, then I would probably leg out of this strategy and look to sell some covered calls against it a little bit later. All right. So that's what we would be doing in this strategy. I was going to throw this in here for a couple of questions. You guys have any questions going on in your head right now? So again, just a little bit of a review. First thing we do, we're looking at the underlying here. I've got a bullish market assumption here. It might want to stay here for a little bit, but what I was looking at is this underlying does have a tendency to try to grind a little bit higher heading into those earnings. Well, this one took a dip there, but I think that it's been beaten up. I think that folks are not slowing down necessarily on buying Amazon. They're actually, while they're not probably shopping at Walmart, they're looking for bargains on Amazon. So that could be a very good benefit to FedEx going forward. The reason why I said Walmart is because we just saw Walmart's earnings and they did that 10% correction. But I do think people still continue to go to Amazon and eBay. albeit maybe a little bit lighter these days because we're paying so much to gasoline, but they are still going to be out there shopping for that. So I'm pretty much wrapped up here though, guys. I'm going to leave it out there for you guys to ask a couple of questions if you guys have anything. If you've enjoyed this video, throw a Y in the chat window for me. Actually, just go ahead and smash that like button for me. That helps out too. If you guys want to take advantage of those morning market commentaries where I'm doing spotting the trades, looking for opportunities in the markets, make sure you subscribe with the bell. You subscribe, there's going to be a bell that pops up there to the side. Click on that because that will send you a notification as soon as I hit live on my platform or I'm going live. It'll tell you it's a heads up because in those videos, I talk about the daily market commentary and some option strategies we can implement on any given day. All right. So if that sounds like something you want to take advantage of, hit that like button, smash that subscribe with the little bell there. The subscribe will let you know in advance when I'm going on, but those morning market commentaries, albeit they are scheduled for a specific time because I have to, I just pop in. I schedule that out a little bit further and pop in when I have something to talk about, like the economic data points are coming out. I'm going to pop in there and give them to you as close to live as possible. All right. So that's all I got for you guys. Make sure you guys take advantage of this. You guys are along this course probably far enough that you guys do have some questions. I know it's hard to throw some questions over there at YouTube or Facebook. I don't always see those until later. I will circle back around to answer those questions for you. But if you want like immediate access to me, you guys can take advantage of this. You get the entire course, everything I've ever done. You can go back there, like I said, with this diagonal, long call diagonal. Some of the other videos, the other webinars, I actually talk about different aspects of the strategy. I might be talking more about a bullish one, or I could be trying to break it down very basic for some folks that have never traded a single option. So take advantage of that. I also have beginner courses in there that you can take advantage of if you're very new to trading. And you can reach out to me. I will respond as soon as humanly possible because I know when you have a question, especially when you're trading, you kind of want an answer right away if this thing is going to work out or not. You'll have access to me for 97 bucks. If I can save you on one trade, it's probably worth that. So outside of that, I want to thank you guys all again. The link I'll throw over there in the chat window for you that you guys can take advantage of this opportunity. Whoops, I don't know why I did the delete on that. Let's push it in there. Enter. All right. So again, this is not a hot link. You can type this into your URL. That's probably the best way to do it. Or simply hit the link over there that I just put in the chat window. So you guys all enjoy it. Appreciate you. Thanks for coming back. I noticed a lot of returning names. Appreciate you guys sticking around. Have a great day. We'll see you tomorrow in spotting the trade sometime around, what, 9 o'clock in the morning? If you can't take that, you missed. Take it easy. Bye for now.